We are Group 3, and our article was called SEWMEX Short-Term Profit Planning in an International Setting. This article was a case study, and we were informed to answer the questions that were given to us at the end of this article, so try to bear with us throughout this video. SEWMEX is a newly formed sewing factory that is located in Mexico but owned by an American company. The president of this company recently resigned. With his resignation, many of the calculations concerning the factory SEWMEX mysteriously disappeared. Our group became the new assistant controller, and we were asked to perform new profit planning exercises. You will see the abbreviation SAMS throughout this video presentation, and it stands for Standard Allowed Minutes. This is the standard production time per garment.
My name is Sarah Strobeck, and I'll be describing cost, volume, profit. The cost, volume, profit analysis expresses the relationships among cost, volume, and the company's profit. Three qualitative factors that affect a CVP assumptions are the relationship with suppliers and customers, and a decline in the market. CVP can be used as a managerial tool because managers determine the sales volume that will be needed just to break even or cover cost. They also determine the sales volume that will be needed to earn target profit. They prepare for and respond to economic changes such as increases in costs from suppliers.
My name is William Keene, and I had to do question 2, cost behavior issues. First part of the question was to define fixed and variable costs. So fixed costs is costs that stay constant in total despite wide changes in volume. And variable costs is defined as costs incurred for every unit of activity. As a result, total variable costs change in direct proportion to changes in volume. Next, we had to use a table of SEWMEX's monthly budgeted costs and label each department as having variable or fixed costs. After we needed to find both the total variable and total fixed costs in pesos and US dollar amounts. All of the numbers were in pesos with the given exchange rate of pesos to US dollars being 13:1. So we took all of the peso amounts and divided them by 13 to get the numbers for US dollars. We found the total variable cost in pesos to be 2,205,000 and the US dollar amount to be 167,308. For total fixed costs, we ended up with 1,625 pesos, which converted to 138,846 US dollars.
My name is Alex Jeffries, and I'll be talking about the different profit planning models for the SEWMEX plan. The first one I'd like to talk about is a cost-volume profit analysis. A cost-volume profit analysis is an analysis used to determine the break-even point of cost and volume of goods. It can be used for managers making short-term economic decisions and also for general educational purposes. Based on my table I created in Excel with inputs from my other group members, the break-even point of SEWMEX is about 46,170 units. For the second part of my question, I created a profit volume graph for the SEWMEX plan. The profit volume graph shows the relationship between SEWMEX's earnings or losses and its sales. This graph can also show the company how different levels of sales can affect their profits. Companies such as SEWMEX can use this chart to set sales goals, analyze project profitability, as well as determine where the break-even point lies.
Hi, my name is Jake Bornhorst, and for this video I was assigned to do part number 4. On this slide it just shows everything that you need to know. It has Table 1, Table 2, and Table 3 from our case study. Okay, so for question number 4, Part A was about finding the break-even point, and currently SEWMEX is operating at a monthly planned production level of 2,500,000 SAMs. At that level, current costs are $318,461.53 as seen in Table 3 after exchanging pesos to US dollars. However, after using information provided to find the contribution margin for each type of unit produced, you find that current revenue is $388,550. So they're generating a profit of $70,088.47, which is roughly about 18.038%. So if you were to cut back on SAMs by 18.038%, you would be at roughly 2,049,000 SAMs, generating $318,461.53, which is equal to total cost, which is the break-even point. And on the next slide, I have all the math that went into that. Okay, so here are the calculations that I used for this part. At the top it shows how I got the percentages for their profit margin, and then you use the 18% of 2,500,000 SAMs, which is 2,049,000 SAMs. I checked my work by applying that 18% cut to each amount of units produced in the contribution margin, and that's down like on the bottom half of the slide, and that's the numbers that I got to check it, and it all turned out alright, so it worked. Then the next part of part A was to find the break-even point and total units. So you simply add together all the units from finding the contribution margin. So the math would be the numbers I have listed there. I'm not going to go through there and say them all because that'd be boring, but that's the number. Okay, the break-even point in dollars would be equal to the total cost, which was $318,000 or $318,461,000.53. So I touched on this a little bit on the previous slide, so I'll show the math again on the next slide. Okay, so I got these numbers by cutting back the production of units by 18%. So after you do that and then multiply them out by the cost, then you add all the total costs together, you'll get where your break-even point was. So, I mean, it's kind of confusing, but if you think about it, it's easy. Okay, we skipped part C of this question because it was irrelevant and we didn't need it. But in here I showed the product line break-even points in units by showing how much dollars they made in revenue per month.
This is Lauren Grimes, and now I will touch on the efficiency with SEWMEX. This table shows the information that I used to figure out the efficiency of SEWMEX. The product line of SEWMEX consists of pants, shirts, jackets, and a category labeled Other. The total production level per month was 2,500,000. The efficiency level in the Mexico factory is 2,448 SAMs per week, using the 85% efficiency in the U.S., which was labeled as the average. Mexico is more efficient by 408 SAMs per week compared to the U.S. This may be because in Mexico they work 8 extra hours per week compared to the U.S. workers. After working all these profit planning exercises for SEWMEX, we have drawn some conclusions. The factory SEWMEX focused on manufacturing pants, shirts, jackets, and whatever was in the category labeled Other. The variable costs for this company are higher, coming to $167,308 per month, compared to the fixed costs, which are $138,846. By using the information provided, you can see that at the current output, they are at an 18% profit margin, putting this factory at a good profit per month. Also, the contribution margin of jackets is the highest at $22.59 per month, therefore making jackets the most profitable. If SEWMEX continues on this path that they are on, they will continue to be a successful factory.